Many retail traders rely on lagging indicators or gut feel, oblivious to the fact that big money, banks and institutions leave footprints in price action. Other blocks and fair value gaps are two powerful smart money concepts that reveal these footprints. Other blocks mark levels where institutions placed large buy sell orders, while fair value gaps show price imbalance left by rapid moves. In this video, you will learn what these are, why they matter, and exactly how to spot and trade them using price action alone. Stick around to see a side-by-side example of both in action and learn the common mistakes to avoid. An odd block is a chart zone where big institutions placed significant orders. It often appears as the last opposite direction candle before a strong move. For example, a bullish order block is typically the last down bearish candle before a big rally. Conversely, a bearish order block is the last up bullish candle before a sharp drop. These zones act like magnets for price. When revisited, they often serve as support resistance where price reacts. In other words, order blocks are supply-demand zones created by smart money. Understanding them gives you a significant edge. They predict where price is likely headed next because they pinpoint where large orders were placed. Key points: institutions create these blocks during consolidation phases and then drive price sharply away, creating an imbalance. Why they matter? Retail traders can use order blocks as precise entry-exit zones. A bullish order block is a potential long entry support, and a bearish block is a potential short entry resistance. Spotting order blocks and how to identify them. Once you know what to look for, finding order blocks becomes a systematic process. Here's how to spot them on your chart. Look for consolidation plus breakout. An order block usually forms during a sideways or choppy phase. Then price breaks out decisively. For example, after price consolidates, a big bullish candle breaks above a swing high. The last bearish candle in that consolidation is your bullish order block. Check market structure. Valid order blocks often take out a recent high or low, a liquidity sweep. A bullish order block usually follow up a down leg where big buyers stepped in, creating a new support floor. A bearish order block follow an up leg where sellers accumulated, forming a resistance ceiling. Use higher time frame. The most reliable order blocks appear on H4 daily charts, where institutional orders are visible. Avoid short-term noise. Focus on large swings. Unmitigated zone. Ensure price hasn't already filled the block. A true order block remains unmitigated, meaning price has not yet returned to that zone after initial break. For example, imagine Euro USD in an uptrend. Price pauses and forms a small base, then surges up. The last red candle before the surge is a bullish order block. Mark that zone. Later, when price pulls back into it, you watch for a bounce. Fair value gaps are another smart money clue. They show where price skipped over price levels during a fast move. Simply put, an FVG is a gap between candles caused by a rapid price spike. For instance, if one candle opens at 1.1 and the next open at 1.1020 with little overlap, the 20 pip blank space is a bullish fair value gap. This happens when price moves so fast that there isn't enough liquidity at intermediate prices, often driven by news or big institutional orders. Because these gaps highlight inefficiencies, area where buying and selling pressure was extreme, they become targets later. Traders and institutions believe the market will fill that gap to reach equilibrium. In practice, bullish gaps suggest strong upward momentum, and bearish gaps, price dropping past the previous open, signal downward pressure. FVGs are like mini supply demand zones. They form quickly but can power moves just like other blocks. Smart money traders use fair value gaps as potential retracement zones. Here is how to work with them. Identifying the gaps. On your chart, find where price had a clean jump. The area between the candles, usually week to week, is the fair value gap. Wait for retracement. After the gap forms, price often comes back. Fill the gap. For a bullish gap, price may dip into the gap zone. For a bearish gap, price may rally back up into it. This is your setup opportunity. Enter on confirmation. Once price enters the gap area, look for a sign that imbalance is correcting, e.g., a rejection candle or reversal pattern. Then trade in the gap's direction. Long on bullish gaps, short on bearish gaps. Traders often wait for price retracements into the gap to open positions. Manage risk. Place stops just beyond the gap edges. If a bullish gap fails, price falls below the gap. The setup is invalid. In essence, a fair value gap is a clue that smart money pushed price hard and left behind unfilled orders. By trading the gap fill, you align with how big players often enter or exit positions. However, remember that not all gaps we fill is a sign, not a guarantee. If you found this video helpful, smash that like button and subscribe for more price action trading strategies. Drop comment if you have any question and check out our Telegram channel for trading secrets. Thanks for watching, and I'll see you in the next one.